Welcome back to the New Year special edition of Money, Money, Money. Well, let me start by asking you, Gaurav, do you have a resolutions list in mind when it comes to personal finance?
I have more of developing habits than resolutions, because resolutions are more like euphoric. Beginning of the year, you make all the resolutions and they just go away. So develop small habits, which is what we've always been saying that. But get into a system of which is what people most of the time end up missing is when all will you require money. So whether I'm going to basics of personal finance, look at your financial goals, but ensure that whenever you need money, you have earmarked investments for that. So that, you get that money when you need it. You're not dependent on how market has gone up or gone down. I mean, if digitization is a big thing that we are talking about, slowly start moving towards it, because that's the way forward.
Sure.
So develop these small habits.
I guess there's no shortcut. You just have to get sensible if you want to, start with the basics of making money.
So you want to make money, then there is no shortcut.
There is no shortcut. All right. So Kartik, what's your checklist looking like if you have one?
So a large part of our usual stuff remains the same that we need to do. However, based on situation and circumstances that we are in, and in the backdrop of demonetization, there would be a certain number of things to do which are so relevant in today's time and which you might want to look at. So top of the list being going digital. How would you do it, and how would you go about doing that? How would you go around spreading the message of digital to every person in your life? That's of course top of the line. Second is your interest rates, which are moving in a positive direction for you, where they are going down. So how would you sort of play the interest rate and play your home loans accordingly? Automatically that has a bearing on your investments.
Right.
Side by side you start looking at your insurance. There will be a lot of changes and activities happening in that space. And eventually a very important aspect of all this, data analysis and data gathering and digitalization and all that is in some sense forcing you to start looking at all the paperwork that you've had for so many years and which you have in some sense ignored. You've had multiple relationships, and then how do you consolidate all those things?
That's the hardest thing, I think, if you ask me personally.
It's extremely time consuming and, but it's something which you must pay attention to now more than ever. And that's become so important to do for this year.
Okay, so that's like a top 5 checklist to keep in mind. Let's start going down into some of these aspects individually. Starting with, of course, the way interest rates are changing, because that's been the biggest headline, right? We've got such a massive rate cut from the State Bank of India already. There seems to be, a general thrust towards cheaper home loans.
Indeed.
What's your sense? Is this a good time to be looking at property? If you have a loan, do you need to start switching around? How do you approach home loans?
Just a quick statement. If you're looking for a home and if you're looking at a builder property, I don't think the prices are coming down. If you're looking at resale, better act really fast, because it's a wonderful time to actually strike a deal. And therefore, if you have to go in for a fresh loan, of course you're in for a sweet spot that you're in. So with SBI leading the announcement of a 90 basis point cut in their MCLR, which means they are down from 8.9 to 8, and most of the loans that they are giving, ranging from 30 lakhs, depending on the loan size, are all ranging between 8.5% to 8.7%, which is a fabulous spot to be in. So why not start investigating that? For all the people who already have loans, if you're on the MCLR system, automatically all your respective banks will start doing this thing. I will definitely see a competitive environment coming all across, and everybody is going to start slashing rates.
Sure.
But then it's really obviously at the end of the day, it's a fabulous situation for all the home loan buyers and the new home purchase buyers, and as well as the people who are with the home loans.
So, Gaurav, your thoughts on housing loans. If I'm looking at buying a house and looking at taking a loan right now, do you think it's better off to go to one of the larger banks, or do housing finance companies make sense to you? Where do I start?
So it depends, but shop around, because there is so much competition that you can't say choose this over this, number one. Number two, builders do have tie-ups. So if you're looking at a direct new purchase, then look at where the builder has a tie-up and if there's some kind of benefit that's coming to you. If it's a resale, go to your existing bank where you already have a relationship and see if they are willing to offer you something special. If that's not the case, then, because end of the day, beyond a point, there will not be much differential. And if somebody is offering you less, and if you go to other institutions and say, look, this is what I'm getting, there are chances they'll try and match it up or pay off some kind of processing fee or admin fee, something here or there. But please shop around, because with so much liquidity in the system, which is what has happened because of this demonetization and whatever, and PM actually nudging, saying, please start giving away benefit, we will see interest rates coming up and competition. Hopefully it's going to be buyer's market.
So, Kartik, quick last point on home loans, the fixed versus floating thing. I mean, I don't think there's a pure fixed sort of a loan in any case. I mean, if you want to lock in at 8.34%, you can't do that for the entire tenure of the loan, right? So, what's the right mix to have? How do you go about structuring this loan in the current environment?
I would say that in the current scenario, just straight away look at floating, because we are looking at a situation, we are looking at a regime change and a structural regime change that is going to be downward. It's going to be downward for a long time. So definitely do that. There will be players who will entice by giving you a certain fixed rate of, whether that fixed rate is for 5 years or 10 years or 3 years is something which is going to be determined by market forces. But as a wise investment management of the home loan, I think just go for floating straight away.
In fact, if they're pushing fixed rate, then you will better go for floating.
Indeed.
Because obviously, because they are worried that if interest rate starts going down,
they're trying to make you go fixed.
Exactly.
Whereas, I mean, you might just see lower numbers.
And they may just lure you saying that a floating A rate pe hai, fixed itne pe le rahe, why don't you take it? But basically, it means is we are flush with liquidity, we are going to go further down, you please lock in.
So go for floating. That's the clear takeaway from this. Now let's move to the other aspect, and that is investments in 2017. Broad thoughts, Gaurav. If you were looking at these are very specific things about individuals. We get that in personal finance. But broadly speaking,
we are looking at a situation now, and hopefully that continues, is that system is flush with liquidity. If it is, and if lending rates are coming down, then we are going to see some kind of appreciation in equity market for sure. And there are also expectations from union budget. So going further, this has to give results. With so much liquidity bringing into system, banks' balance sheets improving, with a lot of people paying it back, we are on a more healthier front. And if that has to happen, then we are bound to see better results. It's just that there is this entire fear and whatever, that the real estate market went down because of white economy and whatever, but that has been taken care with reduced interest rates and real estate sector picking it up.
So in a nutshell, Kartik, the ideal looking portfolio, I mean, asset class investment mix that comes to mind now?
See, right now, I think it's a very good idea to stay in bond funds and keep a substantial allocation, maybe as much as even 40 or 50% of the allocation. The reason for that is very simple. With so much of liquidity in the system, and the fact that interest rates will go down, equity markets will eventually do well, but the first immediate benefit is going to be in terms of the bond markets, because automatically you will have capital gains that will accrue to your account. So even if you're expecting something like 10% plus or something of that sort, maybe for the next 12 to 18 months, that's a definite possibility. What happens as a result of that is, as a 5-year average, you're going to be way above the bank rate.
But then what kind of funds? Because I mean, the duration can vary. I mean, should you be in debt funds which are primarily of sort of 1 to 3 year duration? Should you look at 5 to 7 years? Should you look at a dynamic bond fund that plays across maturities?
So I would think you go with a fund which has a duration period of about 1 to 3 years, because that's how you will take advantage of the situation. And of course, if you have to eventually move towards equity, start your STPs into equity and start those equities to be distributed to equity, say over, for example, the next 24 months or so. But right now, a big chunk should be there, because again, we are expecting in February to see some sort of rate cuts. Maybe in June again there will be some more rate cuts. You will actually make a substantial amount of profit out of these bond funds rather than simply going to fixed deposits. So a lot of people should start learning about bond funds if you've not done that already.
All right, we need to take a very quick break on that note, but on the other side, we'll talk about certain behavioral aspects that are perhaps really worth keeping in mind as you're looking to set your personal finance house in order in the year 2017. We'll be back in a moment.